Welcome to this explainer on how individual behavioral biases warp financial decisions and ultimately scale up to distort entire global markets. If you've ever wondered why incredibly smart people do, quite frankly, some really foolish things with their money, well, you are definitely in the right place. Let's kick things off with a kind of uncomfortable question. Why do supposedly rational people routinely make highly irrational, emotionally driven financial decisions? Traditional finance theory assumes we all act like, well, perfectly logical computers, calmly crunching all the available information to optimize our wealth. But behavioral finance looks at how we actually behave. It proves that when faced with complex decisions, our brains rely on mental shortcuts. And while those shortcuts are quick, they often lead to some serious financial sabotage. Okay, here's our roadmap for today. We'll start with the flawed financial mind, look at belief perseverance and information processing, explore those dangerous emotional biases, and finally unpack massive market anomalies like bubbles and crashes. Section 1, the flawed financial mind. As we start challenging this old idea of perfect market efficiency, we absolutely have to draw a hard line between the two main categories of behavioral biases, cognitive errors and emotional biases. Think of cognitive errors like software bugs. They're basically mistakes in reasoning, statistics, or memory. And because they're logical errors, we can usually patch them with better information or education. Emotional biases, on the other hand, those are deep-seated hardware flaws. They stem from impulse and gut intuition. They just arise spontaneously, which makes them much, much harder to correct. Honestly, often the best we can do is just recognize them and build systems to adapt to them. Section 2. Belief perseveration biases. So when new information completely contradicts what we already believe, our brains absolutely hate the stress it causes. It's a psychological discomfort known as cognitive dissonance. To dodge that mental stress, we fall right into traps like conservatism bias. Conservatism bias means people stubbornly cling to their old forecasts, even when entirely new conflicting data is staring them right in the face. Instead of properly analyzing the new evidence, they just underweight it, especially if that new info is super technical or just a headache to process. There's a perfect example in our source material about an investor named Gerber. He was heavily invested in a biotech company. When the company announced serious clinical trial delays, which, let's be honest, clearly signaled early signs of failure, Gerber completely dismissed them as just temporary setbacks. Why? Because updating his original belief that this company was a surefire winner caused way too much mental stress. He failed to properly incorporate that newer complex data, and he definitely suffered the consequences. Then there's hindsight bias. Oh, we've all seen this. This error causes us to look back at poorly reasoned decisions that just happened to get lucky and rewrite history to frame them as brilliant tactical moves. Or, on the flip side, claiming that a completely unpredictable market crash was literally obvious all along just because you dug up a few leading indicators after the fact, it completely prevents us from accurately judging our own actual investment skill. Section 3, information processing errors. Moving on to how the brain illogically processes the data right in front of us, framing bias shows us that the exact same data can prompt completely different investment choices depending purely on how it's presented. Our brains react to the packaging of the information rather than the underlying mathematical reality. Think about this scenario for a second. An investor might happily fund a venture capital pitch if it's presented in a gain context, like, hey, 1 in 4 startup companies succeed. But that same investor might completely walk away if given the loss context. 3 out of 4 startups fail. It is the exact same mathematical probability, but the frame completely flips the financial decision. Meanwhile, availability bias severely limits our investment choices because we estimate probabilities based merely on how easily information pops into our heads. Like, do you invest mostly in a specific sector just because it's your narrow range of experience? Or do you buy a stock just because the company's name is easily retrievable from a news headline you saw this morning? If so, your brain is taking a lazy shortcut instead of doing the hard work of fundamental analysis. Section 4. Dangerous emotional biases. Now, we are moving out of those cognitive reasoning errors and straight into the impulsive, deeply intuitive world of emotional biases. And here's the big one, loss aversion. The psychological pain of losing money is far, far sharper than the joy of making that same amount. Because we hate that pain so much, we start taking totally irrational risks just to avoid locking in a loss. This dynamic creates what's called the disposition effect. It is a massive trap. Take the case from our sources of a hedge fund manager named Tiffany Jordan. When looking over her portfolio, the sheer pain of seeing underwater positions was so intense that she held on to them, just hoping and praying they'd break even, actively adding risk to her portfolio. Simultaneously, she sold her winning assets way too quickly just to lock in that joyous feeling of a profit. She wasn't managing her portfolio, she was managing her emotions. Overconfidence bias is incredibly dangerous too. It's having completely unwarranted faith in your own abilities. Take the analyst in our source material, who predicted a 40% rise in oil prices. He irrationally claimed to his portfolio manager that there was no credible downside risk of oil dropping. None. That is certainty overconfidence, and it's usually fueled by self-attribution bias, where investors take personal credit for every successful trade as ironclad proof of their own genius, but instantly blame the broader market or the Fed for any losses. We also see a lot of regret aversion bias. This is where the paralyzing fear of being wrong leads investors to just herd right into popular stocks. They think, well, if this investment crashes, at least everyone else lost money too, so I won't feel uniquely stupid. It echoes the famous observation by economist John Maynard Keynes that worldly wisdom teaches it is better for reputation to fail conventionally rather than to succeed unconventionally. Section 5. Anomalies, Bubbles, and Crashes. Okay, now we really need to zoom way out. What happens when millions of individual investors, all exhibiting these overlapping personal biases, interact in the market at the exact same time? Well, they aggregate into massive market movements. Take the memento effect, for example. This is where assets just keep trending upwards for up to 2 years, simply because investors suffer from availability and recency bias. They look at a rising stock and emotionally extrapolate that recent past performance straight into the future. To prove that this creates measurable, totally predictable market deviations, a massive London Business School study tracked the UK market for 52 years. They found that simply buying the top 20% of past winners and shorting the losers generated a staggering 18.3% annualized return. This momentum effect was completely invisible to traditional economic models, but it's perfectly explained by human behavior. And market bubbles? They are cooked up with these identical ingredients. In a rising market, everyone makes money. Thanks to self-attribution bias, investors get dangerously overconfident in their own skills. This naturally leads to high trading volume and the total, stubborn rejection of any contradictory information. And then, the folks sitting on the sidelines finally jump in at the absolute peak simply out of the painful regret of missing out. It's literally a perfect storm of emotional biases. Finally, we see value anomalies driven by what's called the halo effect. This is a sneaky form of representativeness bias, where investors emotionally overvalue growth stocks simply because a company has a great historical track record or a famous visionary CEO. They just assume a good company automatically equals a good stock, and they price it emotionally rather than fundamentally. This creates huge mispricing anomalies in the market. So, we've seen how cognitive software bugs and deep-seated emotional hardware flaws don't just ruin individual portfolios, they can actually drive massive global bubbles and crashes. As you look at your own investments today, I want to leave you with a final provocative thought. Are your financial decisions truly based on rational, fundamental analysis? Or are hidden cognitive and emotional biases secretly pulling the strings behind the scenes? Thank you so much for joining me on this explainer, and I highly recommend you take a hard, honest look at your latest trades through this new behavioral lens.